Hello and welcome to Market Domination. I'm Josh Lipton, live from our New York headquarters. There's just an hour to go now until the closing bell, and stocks are mixed here. The Dow holding on to gains after two consecutive record closes. Our very own Jared Blikre standing by with all the headlines. Jared.
Thank you, Josh. Yeah, looking kind of similar to yesterday. Dow going for that third straight record close, hit a third straight record intraday high. Let's check out the intraday price action here. You can see green almost the entire day, just went negative a little bit before the 2 p.m. Eastern hour, still holding on to gains of about 120 points or 1/4%. NASDAQ a little bit in the red here. We're going to call that 1/4%. And the S&P 500 just barely down about 10 basis points. Meanwhile, the S&P 500 equal weighted index, calculated a bit differently. Every stock gets one vote. That is up today, 0.5%, and that's good for a record high as well. Not only that, we're seeing record highs in the S&P 600, that's small caps, and the S&P 400, that would be the mid caps. And we're seeing that just barely here, about 6 basis points to the upside trading. And let's take a look at the bond action, because unlike yesterday, we are seeing bonds a little bit more active. The price is going up, and yields, which is what we're looking at here, yields are going down 5 basis points in the 10-year to 4.14%. In the 30-year, looking for a similar drop, 6 basis points to 4.79%. And meanwhile, the US dollar index just barely positive. You can see a lot of choppy action there today. And then in sector action, this is another change from yesterday. Utilities and real estate are the two leading sectors. Those are very interest rate sensitive. And you see utilities heading up about 2.33%, then real estate up about 1.5%. What's not working today? Financials, and then tech, and then healthcare. All of those are underperforming. Staples also in the red there, just barely. Let's take a look at the NASDAQ 100, and you're going to see a lot of red in the mega caps, except for Tesla. That's up 2%. Microsoft a little bit positive, but not really seeing a whole lot of big downside action in those bigger names. But let me drill into the software space, which we've seen this under pressure recently, but we're seeing more green than red today. Datadog is standout, up about 15%. Shopify up 7%. And then in semiconductors, looking a little bit more red than green. And you can see the biggest one, NVIDIA, down about 0.5%, while Taiwan Semi, the biggest fabricator, up about 2% there. I'm going to leave us off on the Dow Jones Industrial Average, and aside from the mega caps, which we looked at, I'll call out Home Depot up about 2.5% and Procter & Gamble up about 1.5%, Josh.
All right, thank you, Jared. Will tech stocks get left behind in the next market rally while the Dow is holding on to gains as the S&P and the NASDAQ fall? Heavy hitters like NVIDIA, Alphabet, and Meta turning negative. Our next guest says tech leadership is not likely to continue going forward. Joining me now, we got Chris Maxey, Wealthspire Advisors Chief Market Strategist. Chris, it is great to see you. So let's talk about this great AI trade, Chris, because you have thoughts there. You say the AI build out, it's entering a new phase, you point out. It's funded with debt, not free cash flow. Walk us through that change, Chris. Why is it happening? Why does it matter for investors who are listening right now?
Yeah, so as we're seeing it right now, the AI trade is going into, let's call it the third or the fourth inning, right? So many people have been wanting to talk about, are we in inning number 1, 2, 3, 4, 9? Where we see it right now, we've moved from utilizing free cash flow, we moved away from being able to use equity issuance, and companies are now having to go to the debt markets. Why? Because capex is being measured on the order of hundreds of billions of dollars
Hard to
this
get your
year.
head around some of those numbers.
Yeah, and the numbers aren't just getting big, they're growing faster and they're accelerating. So the way for companies like Google and Amazon and others to stay ahead, issue debt, build out faster. We saw that happen with Oracle at the end of last year, and now other companies are moving in that same direction.
Right now, investors broadly, Chris, they seem okay with big tech, taking on debt to finance their AI dreams. What could change for investors about that?
Investors are going to ask the question, is it paying off? And right now, what we're seeing, yes, it's paying off. ROI, ROIC,
I was going to ask that,
all of that is there.
You have to gauge this, right? Yep. So when you look at that, I'm curious, what are the data points, the financial metrics you're watching? You're like, okay, is all this just historic spend paying off? What are you watching?
Well, it's a little premature for any of it to show up, right? We're going to need a couple of additional quarters to be able to make that assumption. We can look at the capex spending, we can look at sales, revenue growth, we can see whether companies are meeting the targets that they're outlining, and currently they are. So the point over the last couple of quarters is that companies are achieving the bar that they're setting, and we don't know if that's going to continue. Our guess, as you look out over the next 12 months, you look out over the next 24 months, the bar is going to start to move a little bit lower, incrementally lower, and that's why investors are going to say, okay, it's time for us to shift gears. Yeah, we've been happy with the tech trade for so long, but perhaps we need to look in different directions. We're over-allocated, we're overweight to tech. It's time for us to think about other asset classes, other sectors, other areas of the market that we've been forgetting about. So pay attention to the ROI, pay attention to the ROE, but right now it's still there, it's still being delivered.
Sticking with AI though, Chris, what do you make of just the rout in software? Jared at the top of the show was talking about, maybe some signs of stabilization there, but some of these names have just been murdered, right? Does it make sense to you? Did you look at that and say, okay, well, that seems reasonable, or no, it's an overreaction?
I think it makes sense right now because nobody knows who the winners and the losers are going to be. So, in a world where you don't have the benefit of that knowledge, you say, let's take everybody out of the market, let's forget about all of them, and then we'll assess the competitive dynamics later on. We are seeing that the competitive dynamics are going to begin to change though, right? We're going to tease out who the winners and losers are a little bit later this year as we start to progress forward. Right now though, AI is coming for every industry. We've seen it happen in the insurance industry as recently as yesterday, and all insurance stocks were down. Does that mean that every insurance company is going to be out of business in 10 years' time? I don't think so, but you need a couple of quarters, you need a couple of years to be able to determine where the impacts are and to be able to make that assessment.
You talk about the rotation we're seeing there, Chris. Let's just dig into that. So you point out energy, industrial, small caps outperforming. You expect that outperformance to continue?
We do, and the biggest reason is that your starting point is what's going to matter. So starting point valuations are lower for all of those segments. Whether you're looking at international stocks, you're looking at small cap stocks, if you're looking at energy, industrials, anything of a cyclical orientation, your starting point valuations are lower such that your go-forward return expectations can be better. So we've been guiding clients, we've been working with clients to say, all right, you've had technology in your portfolio for 10 years, 15 years, maybe even longer, and it's been in favor. Let's just think about moving in a slightly different direction. What we're finding is that a lot of people are underweight all of those pockets of the market, so you have this flow of funds that's coming out of tech, out of growth stocks, moving in those directions, and that's going to continue to be a tailwind. So don't also forget that economic growth is starting to accelerate. We've seen over the last 6 months, as you introduced the OBBBA, that economic growth is accelerating. That's going to continue this year. You have tax refunds that are coming. So those cyclical companies now have that tailwind, in addition to lower interest rates, which is in their favor too.
Do you want to, Chris, stay focused in the U.S., or are you telling clients also look overseas?
So we've been talking about overseas and international for some time now, and we would say continue to think overseas. Think about having a global portfolio. It's not just a U.S. story anymore. U.S. exceptionalism was there for a long time, and there are a lot of reasons as to why that was the case. That exceptionalism trade is evolving, and I think it's going to look
Chris?
different.
How so?
So what you have right now is this dynamic of things like energy stocks overseas. You have tech growth happening overseas. You have communities that are starting to pop up in places like Europe, in Eastern Europe, in the Northern European countries. And we're going to continue to have that. Not to mention China, right? China has a budding, growing technology industry that is all in on artificial intelligence. We've seen that trade beginning to grow, and that turn is now happening in the Chinese market. Most U.S. investors don't have nearly enough international exposure in their portfolios. There's been a very strong home country bias for a long, long time, and as that flow of funds begins to move out of the U.S. overseas, you're going to see that perpetuates itself for a while.
Final question before I let you look at that jobs report tomorrow. What do you expect there? How important is that for the market?
Markets are constantly wanting to talk about the jobs report. I don't know that a single month of the jobs report is particularly meaningful. The Fed is in a steady state here for a little while, so right, they're wanting to know, is the AI going to impact the labor markets? Is that something that they should be aware of? Do they need to bring down interest rates to accommodate weakness in labor markets? But realistically, what we're seeing right now is that it's pretty steady as she goes in the labor market. This report will be incrementally important, but the trend is exactly what we think it is. Hiring is relatively sluggish, but layoffs are not happening at a rapid or an accelerating pace. So we have a labor market that's in a stall mode, if you will, and I don't know that tomorrow's report is going to change that narrative.
Cooling, not crashing.
Yeah.
There you go. Chris, thank you. Appreciate it.
Thanks, Josh.
Coming up, would you back Google for 100 years? The tech giant seems to think so as it embarks on a massive bond sale. Jared Blikre breaks it all down next on Market Domination. Google's parent company Alphabet has put out a limited deal to sell a rare 100-year bond. Yahoo Finance's Jared Blikre joining now with a closer look in the latest installment of Stocks in Translation.
Yes, Google's parent company Alphabet is just tapping the bond market with a 100-year time frame. No joke, this bond is not going to mature until the year 2126. And the wild part is investors could not get enough of it. On today's Stocks in Translation, we're breaking down what this so-called century bond actually is and why a company that's drowning in cash, why they would want to borrow in the first place. So Alphabet is raising about $32 billion across multiple bond deals in multiple currencies, and only a smallish part, 1 billion British pounds, is for 100 years. But let's back up a minute and add some context about the difference between stocks and bonds. So stocks are ownership. Bonds are a loan. With a stock, you own a slice of the company. You buy it with the hope that the stock price goes up, and maybe the company pays you a dividend. With a bond, you're lending to the company money, and they pay you interest until the maturity date is reached, and then they pay you back the original amount, and you get to keep all the interest. Now let's talk about who buys something like this. Some buyers, like pension funds and insurers, want steady payments for a very long time. Their promises to pay people last decades. So guess what? They like investments that last decades. Other buyers are just making a big clean bet on interest rates, hoping to buy low and sell high, or vice versa. And why would Google's parent company want to go into debt when they're neck deep in cash anyway? Because AI is turning tech into a hugely expensive infrastructure build out, and even cash-rich companies like to have cheap, flexible funding while rates are historically low. Okay, so quick history break right now, because century bonds, they are not anything new. Way back in 1993, Coca-Cola did a 100-year bond. And so did Motorola in 1997, which was the last time a tech company played the century game. The government of Austria, they also sold one in 2017. And if you really want to melt your brain, the UK issued perpetual bonds called consols starting in 1751 with no maturity date ever. So here's the thing to really wrap your head around. It might not come right away, but if you can get this straight, you can talk bonds all day with the best of them. And what I'm talking about is how a bond's price and its yield always move opposite each other. Let's use Austria's 100-year bond going back to its start in 2017. We've got the bond price in white and the interest rate in green. So notice the mirror image. In fact, that's the only thing that you really need to concentrate on. When the price line goes up, the yield goes down. And when the price goes down, the yield goes up. This is a seesaw. And here's why this happens like clockwork. Let's say a new bond is issued at a certain interest rate, maybe 5%, and with a maturity of 10 years. Then let's say other 10-year bonds are issued with higher rates, like all the way up to 10%. Well, our original bond that's only paying 5%, while these others are paying 10%, they don't look that attractive. So the price of the bond starts getting cut until buyers feel like they're getting a good deal. A rough rule of thumb is if yields double, then the price of the bond can actually get roughly cut in half. It's not perfectly like that, but that's a very good starting point. Okay, what do we look out for next when it comes to big tech and big bond offerings? First, we want to watch demand on similar long-term tech bond offerings. Are these deals getting upsized or are they getting cut? Then there's pricing. Is the extra yield that investors are demanding beyond safe government bonds, is that shrinking or is it growing? And then there's a narrative. Does AI stay in build-out mode, or do we start seeing AI turn into real revenue? That answer can determine who wins in both the stock and bond markets. And remember that the pick and shovels trade of the dot-com boom, which was a huge build-out of fiber optics, those cash-rich giants didn't get the huge upside, but they did share in the long, deep downside. Something to think about with Alphabet. And tune into the Stocks in Translation podcast for more jargon-busting deep dives. New episodes can be found Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcast. Back to you, Josh.
All right, thank you, Jared. Well, a new report from Microsoft is showing that more than 80% of Fortune 500 companies are already using AI agents. And as companies race to automate everything from emails to customer support, a new risk is coming into focus: security. Joining me now is Yahoo Finance tech editor Dan Howley. Dan.
That's right, Josh. The kind of proliferation of these AI agents is kind of making it difficult for some companies to keep track of what's going on within their own walls. And so these kinds of agents can do anything from automating certain tasks, helping you put together an email, helping you bring information into your customer relationship management software, things along those lines. There's two problems, though. One is, I don't know if you remember this, but we used to have this thing called BYOD, bring your own device. It was when people would bring their smartphones or their laptops into the office rather than using the office tech. And the problem there was, well, how secure is that smartphone? How secure is that laptop? That's the same thinking here when it comes to agents. It's kind of a bring your own agent. They're starting to see people bring their own agents in, run them on the proprietary information that a company has, and that opens them up to potential threats. The other is that there can be manipulated agents, wherein a company, for instance, may want you to purchase their HVAC supplies or things along those lines. So they may enter a script that basically tricks an AI agent into thinking that that company's particular HVAC offering is the best on the market. And so it'll bias a result if you start looking up HVAC supplies. This is something that has been seen around the web and it's continuing to go around. Now, there is a few other issues that go on here, and that includes things like access to too much data. We can see some of these kind of bots gain access to, say, if you're a clinician, right, and you want to use a bot. Well, the bot doesn't necessarily need to get access to every patient's data, maybe just a sprinkling of a single patient's data. And so there are a few things that are going on here with these bots when they're not regulated properly or not set up properly that can become bigger security issues for companies in the long term.
So let's say there's a CEO watching right now, Dan, and he's got like agents everywhere. They're running everywhere. They're automating this and they're emailing that. He's got people bringing their own agents, right? He's got like this army now of digital gremlins all over his company. He doesn't want them running amok, right? What does he do?
The basic thing is to just treat them like regular people, almost. Not necessarily, give them a lunch break or anything, but there's this idea of zero trust. And I spoke with the folks over at Microsoft who did a study on this, and basically you would ensure that these bots have the proper credentials, have to log into different applications, have the right logins for them. That's the way to ensure that they're not bouncing around and getting access to data that they otherwise shouldn't. It's something that, we do here, right? We have to log in infinite number of times, no matter how much it stinks. Reset your password. My God, I have that coming up. It's annoying, but it does keep things safe. And so that's really where companies are going to be able to use bots while continuing to protect themselves. Treat them like anyone else. Gotta go to happy hour with them. That's not a thing, but you just got to make sure that they're locked down. You treat them like a person that look. You don't want Joe Schmo getting access to the top secret files. Do the same thing with the bots.
Same thing with agents. All right, Daniel, thank you. Appreciate it. Mr. Banner, tax year is shaping up for big tech companies such as Amazon, Meta, and Alphabet. Yahoo Finance's Washington correspondent Ben Worskell joining now with the details. Ben.
Yeah, Josh. So we've in the big tech earnings of the last few weeks, we've also seen some full 2025 tax bills in evidence there as well in annual reports, with a clear trend in evidence, at least among three major players, which is downward tax bills for 2025 compared to 2024. This is a confluence of sorts between this AI tech build out that we've been talking about for months, but also the business-friendly provisions in Trump's One Big Beautiful Bill that he signed last summer and goes into effect for the entire tax year 2025. The numbers are pretty striking. It's billions of dollars less in their tax bills. Amazon's bill dropped from $9 billion in 2024 to about $1.2 billion in 2025. Meta similarly from $9.6 billion in 2024 to $2.8 billion last year in 2025. These are tax credits that Trump signed into law around things like property depreciation, new factory construction, research and development. Some of them are deferrals. It's important to note, so that it's instead of cutting these taxes entirely, it's less spread out. So in other words, you take this deduction up front. So there may be bigger tax bills down the road for these companies. But for right now, it's a clear kind of benefit to these companies' bottom line in terms of right now. And you're hearing that a lot in their messages to shareholders.
I'm curious, in terms of messages, Ben, how you think that story kind of plays out with the public. Like if you were these big tech companies, would you be thinking, all right, I'm probably going to be on the receiving end of some heat here, some criticism?
Yeah, absolutely. So there is a history here of this heat and criticism coming to these companies because of over issues like this. Amazon paid actually $0 in federal taxes in 2017 and 2018, and that got a lot of attention at the time. Very similar situation here, where they use research and development credits, all these different government credits, which is, by the way, how these tax credits are designed. They're not doing anything nefarious here. They're using the rules as they're set up to minimize their tax bill. And you're already seeing some kind of preempting of the criticism that could potentially come here. Amazon had a lengthy statement around this about to make this point that we are this is the rules that Congress set out, and we are playing by those rules. They also note that this is because of their investments. They estimate they've invested $340 billion in the U.S. economy last year. So that's what they're getting credit for. On the other side of this, you are seeing some touting of this as well. This, again, is a boon to these companies' bottom lines, especially this year. Meta's CFO was talking about this on their earnings call recently, saying this is a substantial cash tax savings for the company right now. So they're trying to kind of do both sides of this, and I think you're going to see a lot more of this in the year ahead as we sort of see more companies' full tax situations.
And finally, Ben, before I let you go, we got that jobs report, my friend, tomorrow. Curious, how do you think the White House is preparing for this one? What's the messaging going to be there?
Yeah, we've seen a pretty notable kind of rebuttal of sorts from the White House economic team on these jobs numbers before they're even out, essentially saying these numbers could be lower than the market wants, but that's going to be okay, and you shouldn't take this as a major indicator of the economy. White House National Economic Council Director Kevin Hassett even said markets shouldn't panic over this, describing what's going to be, in his view, a smaller number than many expect. The overall case being made here is that there's other factors here that are putting downward pressure on the jobs numbers here, but that's not an indicator of an economy overall that's slowing. They cite AI productivity, essentially productivity economy is there, as well as Trump's ongoing deportation efforts as major factors here that may drive this number down, but again, shouldn't change the overall economy. Peter Navarro was also pushing this message, and he even made the case that we should be rethinking kind of what is a good jobs report or not. His case is that $50,000 or 50,000 jobs is a good number to kind of keep up with population growth, because basically the U.S. economy is deporting so many immigrants at this point. Either way, what economists are projecting is a report in the neighborhood of 70,000 new jobs added last month, but the range is really wide there. So I think we're going to be in for kind of a pretty unpredictable jobs response, both in the political and the economic arena tomorrow.
All right, Ben. Thank you. Appreciate it. Coming up, the CEO of Superhuman reacts to the recent rout in software stocks. That is next on Market Domination. Now time for some of today's trending tickers. We're looking at wealth management firms, Paramount Skydance and Oscar Health. Going to start here with AI fears shaking the wealth management world. Schwab, Raymond James, and Stifel all under pressure here after tech platform Altruist launched AI-powered tax planning tools through its platform Hazel. So this is sort of our new world, Brooke. You know, you wake up, and congrats, AI is coming after your industry.
Yep, and I think that's what the fear was last week when we saw the software stock sell off. That was the fears that
Absolutely,
someone in their note put the fear of being obsolete, and I think that's what's echoing through right now when it comes to these specific financial stocks. Charles Schwab, once again, Raymond James, you named. But what's interesting is despite this sell-off that we're seeing today, there's still lots of optimism on the street. Take Charles Schwab, for example. There's 19 buys, 4 holds, and 1 sell. And so it's right now, it's this fear. Once it gets to a certain sector, it seems that investors are immediately pulling back, reacting to the day of news. But as we saw with software, maybe this is just a minor blimp as investors kind of assess. They need to sort of figure out and go around how they're going to stay relevant within this AI new dimension that we're seeing.
All right, meanwhile, Paramount Skydance, let's talk about that one as well. Not giving up in its fight to acquire Warner Brothers Discovery. PSKY now agrees to pay the $2.8 billion termination fee that WBD would owe Netflix if that deal were to fall through. So, Brooke, Paramount sweetens the bid for Warner Brothers. Will cover that termination fee. Warner Brothers saying here, we'll review the amended offer, make a rec to shareholders.
Yeah, well, also what Warner Brothers did say here is that they're advised, or rather the board is not modifying their recommendation with respect to the Netflix merger agreement, that WBD will review once again the amended offer and advise its stockholders of the board's recommendation. But it seems like Warner Brothers really isn't gonna budge here. It seems like they're going with Netflix deal. We know that the Netflix executives are currently facing an investigation by the DOJ over possible monopoly here, but they're willing to stand up. Once again, Netflix has an $83 billion deal that already seems to be in cahoots there. They're already working through it, whereas Paramount continues to up the ante with their more than $100 billion deal. In addition to the fact that they said that they're going to cover that termination cost, the company also said that they're going to do this ticking fee. Essentially, they're going to offer 25 cents per share for every quarter the transaction is not closed beyond December 31st, 2026. And so Paramount's still trying to stay in this fight here.
Finally, Oscar Health shares higher on an upbeat outlook as the insurer looks to reach profitability this year. Still, the company reporting wider losses as it struggles with high utilization rates among its customers. So this one higher today, but this one's been rough. Stock in the red year to date and over the past 12 months. They did, though, the revenue, the operating profit forecast for the year, that was enough to beat the street's expectations.
And it seems like the optimism here is what exactly this could turn out to be in 2026. Some rhetoric on the call, as we heard, is while weighted average rate increase for 2026 was approximately 28%, the increase on a per member per month basis is lower, reflecting shifts in member age and metal mix as well. But it really sort of the outlook for this industry, especially with the implications of Obamacare and all that, sort of weighing in on this company as well.
All right, thank you, Brooke. Appreciate it. Well, Ferrari shares popping on the back of its latest earnings. Yahoo Finance senior autos reporter Praz Tumranin has all the details. All right, Praz, fill us in here. They report the stock pops. What did we learn?
Yeah, luxury demand is still there for Ferrari. The company said that, the CEO said the order books are still sold through 2027, so good demand there through this year and next year. But the guidance really has investors sort of excited here. They're seeing revenue of about $8.91 billion next year, up 5% from last year, with adjusted EBITDA in the range of $3.48 billion, up 5.8% compared to 2025. This is better than analysts expected. It's marginally improving, but it's still a good sign, positive sign for the industry, right? Because Ferrari generally in the past, I don't want to say they sandbag, but they've definitely give very conservative guidance, and I think the investors and Wall Street see that as a positive move there for Ferrari. Look, they have an EBITDA margin of 39%. Like, there's no other car makers that have that sort of thing, because they can do stuff like boosting personalizations, higher end cars, even racing, even F1 racing, they're expecting higher revenues there. So a lot going on for the Ferrari story.
What about Ferrari's first EV, Praz? When is that coming? When's the debut there? We have a timeline?
So they said today they're going to show us that first EV in May of this year. It's going to be basically, they call it a sports car, but it's a four-door sports car. So think like a sedan, something like that. We had a glimpse of the interior last week at an event that they held in San Francisco with Johnny Ive, right? The guy who used to run Apple's design. He's now at Loveform, his new design company that actually got bought by OpenAI, I believe. So they debuted some of the interior parts of that car. People are pretty excited about that. It's not just touchscreens. It's knobs. It's dials. It's real things you can interact with. I think that has people excited. It's kind of simple, but also I think it's pretty elegant.
Yeah, I was reading, Praz, some reviews of some people who got like a sneak peek. And just speaking of Sir Johnny Ive, they said it kind of looked and felt like an Apple product. And of course, Sir Johnny Ive, an icon in Silicon Valley, right? The man behind iPod, iPhone, iPad, really helped kind of just transform Apple. But what do you make of that?
No, I think it's a really smart move. Look, the concern with an EV at a high level is EVs are all kind of the same in some regard, right? The motors are quiet, they're very powerful, but it's hard to distinguish between, the motors for a Tesla Model Y and the motors perhaps for a Ferrari, right? They're going to be high performing, they're going to be very efficient. The question is, how do you make it feel different? You can do so with sound, you can do so with materials inside, make it feel a little bit different, tuning of the engine, the motor. But I think what Ferrari did here smartly is they're saying, you know what, we know it's an EV, but we're going to bring back old world craftsmanship. We're going to give you the sensation of driving an older car with knobs and switches, metal switches, an actual dial, with the tachometer, not a digital one. I think that's what has people sort of interested again in a Ferrari EV. And look at that steering wheel right there. That's an homage to an older steering wheel. It's thinner, metal interior there, the tri-spoke there. Very, very cool. I think that's what Ferrari's going for.
Praz, thank you. Appreciate it.
Thank you.
Software stocks have been in an epic rout as investors grapple with fear that AI startups like Anthropic and OpenAI will make these public companies obsolete. The CEO of AI-fueled software company Superhuman, formerly known as Grammarly, joined Yahoo Finance executive editor Brian Sozzi to discuss the uncertainty rippling through the market.
I think the markets go up and down. It'll be fine.
What is, before we get into what you're working on, what should an investor be looking for in some of these software companies? How do they know if they're durable?
I think, I've watched these cycles as mobile, as cloud, and so on. I think you want to see which companies are adapting to it. So I think it's important that the companies that stick their heads in the sand are going to be sunk. But I think a lot of the companies that are being punished right now are actually reacting fine, and they're going to be just fine.
Do you see them reinventing themselves?
I think so.
Yeah. Talk to us about what you're working on at Grammarly.
Yeah, so Grammarly, if people are unfamiliar, we're one of the world's most popular communication assistants, about 40 million daily active users, do over $700 million in revenue. I think it's one of the world's best kept secrets.
I didn't even realize it was that big now.
Yeah, it's a much bigger business than people think. Yeah. But actually the thing people most misunderstand about it is they think it's about grammar, which is a totally reasonable assumption. Right? But actually the thing that Grammarly does is it's the OG AI assistant. It's an assistant that works right next to you. We see 1 million unique surfaces a day. So every desktop app, web app, and mobile app, we can observe what you're doing. We can annotate it in a way that's unobtrusive to you and make changes on your behalf. Right now, we only do that for grammar, and the big change is we're about to do it for everything. So anybody can run agents just like Grammarly on that same platform.
How will that change the user experience?
Yeah, so maybe a simple example. Let's say I'm a salesperson, I'm writing an email to a customer today. Grammarly feels like you have your high school grammar teacher sitting on your shoulder for your red and blue marker, marking everything up. Cool. Now it's going to feel like you have all these other agents sitting with you too. So it could be your sales coach saying, hey, you're about to recommend the wrong product. It could be your support person saying, hey, this person had an outage yesterday, you should acknowledge that. It could just be your electronic or your digital assistant saying, you said you're going to meet tomorrow at 7 p.m., but you have your daughter's recital then. And all of them can help you the same way that we've been helping millions of people with grammar. We're now going to be able to help millions of people with everything else that they do as well.
As someone that is working on, this is amazing technology. Do you fear the next update out of Anthropic?
We're huge customers.
Customer of Anthropic.
Oh yeah, we customer of Anthropic, OpenAI. We do over 100 billion LLM calls a week. If you just judge us as an AI property, we're probably one of the biggest in the world. But we do it in a way that brings it right to the user, so you don't think about it.
Do you worry about them making a product like yours obsolete?
I don't think so. What we do is a little bit different in terms of bringing AI directly into people's surfaces. I think they work a lot on models, they work a lot on what we call the chat interfaces. But if you think about the main metaphors in AI, there's a lot of people focused on chat. We want to talk to an AI bot. There's a lot of focused on what we call do, which is task automation. We work on something we call assist. So if the stat I gave you, 100 billion LLM calls a week across 40 million people, that means for an average Grammarly user, we do a few thousand AI calls a day. So, if you're a really good ChatGPT user, a really good Claude user, maybe you could do a dozen in a day, but we do it every time you type a character, you open a new doc, you open a new application. We're calling all the AI systems on your behalf. And I think at that scale and that level of integration, it's just a very different paradigm for how to think about AI.
What about Superhuman? Now, these businesses were combined. What's the next generation of a superhuman?
Yeah, so we brought together 4 different products. So the original superhuman product, this what we now call superhuman male, Grammarly, my old product called Coda, and the new product we call Go. Go is the platform layer of Grammarly, the thing that lets anybody build agents that look like Grammarly. So we brought all 4 together, and then we decided to change the corporate name, and we had lots of ideas for what to do it, and we decided to pluck the one out from
Sounds cool. No offense to Grammarly, I mean, superhuman sounds
well,
cool.
I think that sounds cool. That's obviously a starting point. That was it.
Gotta sound cool. Gotta sound cool.
It's broad, which I think is really important, so you can cover lots of things. But actually, the thing we love about it is the word human. Because if you think about most people working on AI are really worried about, they're out there trying to replace humans. We have the opposite viewpoint. Grammarly has always been the product that we work with you, but at the end of the day, you write the article, you submit the blog post, you're the one who submits the essay. We're there to assist you. So I like to say we spent the last 16 years turning people into super writers, and now we can spend the next few decades turning people into superhumans.
How much of a job taker do you think AI will be?
I mean, I don't view it as a job taker. I view it as a job expander. So in my mind, we're about to give everybody 100 new employees. And I think what's about to happen is we're going to teach everybody management skills. And I think that is massively.
So I'm managing these 100 agents.
You're managing these 100 agents. And I think it's, for every generation of technology, we sometimes forget what happens when you get scale like that. I think a lot of people look at it as job takers, but I think they are underestimating humans. I think we have lots of things to go do.
If a human is the human that is out there watching this, how could they prepare for this wave of AI? How do they get trained up for this?
I mean, definitely use all the tools. I mean, I think being up to date with every tool that's coming out, it's kind of like, imagine being in the world where spreadsheets were coming out, and there were the people who stuck their heads in the sand and said, we're going to stick with calculators, and the people who said, we're going to learn spreadsheets. I think it's similar. You better know how to do it, and it's going to be very important. But I also think it's going to change the way we think about running our businesses. And I think the analogy of employee to manager is a good analogy. It's closer to what jobs are going to feel like.
You recently joined the Walmart Bar, a company we know very well. They won our 2024 Company of the Year award. New CEO for them, John Furrier, just crossed that $1 trillion market cap because of you.
We both joined the same day. Yep. $1 trillion market cap that day. It was a fun board meeting that way.
What has been amazing about them is their transformation. How important will technology be to them over the next decade as John tries to put his stamp on this business?
I got to say, I just went through my first board meeting there, and it felt like a tech company board meeting. It was demo after demo after demo. And I think the unique thing about Walmart is they apply technology in real business problems, and they can immediately see such scaled impact because they have such enormous scale. And so everything, it's vision, generative AI, and I was watching how everything from watching what people put in shopping carts to making sure the right fridges are updated. Mm-hmm. And it just, the scale of every little investment they make has such immediate impact, and they've done a fantastic job of it.
How do your input, what type of input do you provide to a team like that?
Oh boy, I hope I provide helpful input.
Well, I'm sure you do. I mean, YouTube, Spotify board, now you're in Walmart. You know what you're doing.
I think my role is mostly to help make sure they figure out the right positioning for the future. To be honest, I think they're on the right track. So I think
they're doing okay.
I think they're doing just fine. But the world is changing. I mean, the world of commerce is changing. The world of shopping is changing. I think the idea of having an AI agent that helps you in your shopping experience or brings it into the rest of your experience, I think it's pretty different than what people expect.
2 fun ones, because that's how we roll here at Yahoo Finance. First, are you at Inbox Zero?
I am.
And how could someone not, besides signing up for Superhuman, what's their best email managing hack that you can offer them?
Well, I mean, that is obviously the right.
Just sign up for Superhuman, right?
You took my best answer out. I mean, I'll give you my best one is split inboxes. It is a Superhuman inbox feature, but it's basically, if you think about when you're organizing your desk, you'd pile things together. So I'm going to do the bills over here. I'm going to do all the different related things together. Set up your split inboxes. We have an AI labeler that does it for you, and you just put in text and you say, I want emails like this to go over here, emails like this to go over here, and then we'll sort it, and you can handle all the recruiting things at the same time, all your customers at the same time, all your next guests at the same time.
As the CEO of a company that leads a software platform like Grammarly, do you still write human emails?
I do. Yeah, I absolutely do. A lot of them get auto-drafted for me, but I then come through and make sure they're mine.
But it's still, I mean, it's critically important, especially in your role, to have that human touch, right?
For sure. Yeah. I mean, I think it learns. I mean, I think the Superhuman Mail product learns very quickly what your tone is like. But then you want to make sure it's actually yours.
Well, good luck on everything you're working on. Look forward to staying in touch. I love the predictions you put out on X. I mean, you think we're in an AI bubble?
I think we're in an
I
AI
love
bubble.
those.
But I think bubbles are a good thing. That's the rest of the article.
Yeah. Well, that's good stuff. Keep those predictions coming. I very much like to see them. Shashir, we'll talk to you soon. Appreciate it.
Thank you.
Thank you so much.
Coming up, we dive into the latest Fed speak. Don't go anywhere. Fed officials weighing in on policy outlook ahead of key economic data this week. Yahoo Finance's Jennifer Schonberger joining now with the very latest. Jen.
Hello, Josh. That's right. 2 new voting members of the Federal Reserve say they prefer to hold rates steady now on concerns about inflation. Cleveland Fed President Beth Hammack said earlier today she believes that monetary policy is, quote, in a good place to maintain rates at current levels, and that based on her forecast, the central bank could be on hold for, quote, some time. Hammack says inflation is still too high and sees the risk that inflation could remain persistent around 3% this year, as it has been the past 2 years. She says she needs to see decisive evidence that prices are coming down, and rather than trying to, quote, fine-tune interest rates, Hammack says she'd prefer to, quote, err on the side of patience as the Fed assesses the 3 rate cuts that they did last year and the impact on the economy. Now, elsewhere, we also heard from Dallas Fed President Lori Logan, who says she's also concerned that inflation remains too high and that the 3 rate cuts that the Fed did last year to try to shore up the job market are actually pushing up inflation risks now. In a speech in Austin, Texas earlier today, Logan saying, quote, after last year's rate cuts, it is uncertain how restrictive policy currently is. We'll learn in the coming months whether inflation is coming down to our target and whether the job market will remain stable. If so, this would tell me that our current policy stance is appropriate and no further rate cuts are needed to achieve our dual mandate goals. Now, while Logan does anticipate that inflation will drop later this year as tariffs work their way through goods prices, she says that, quote, she's not yet fully confident that inflation is on its way down to 2%. So just some evidence there from 2 members of the Fed that they need to decisively see a drop in inflation before they consider any rate cuts. Back to you.
Thank you, Jen. Well, for more on central bank's next chapter with policy, let's get to Danielle DiMartino-Booth, QI Research CEO and Chief Strategist, and also previously an advisor to former Dallas Fed President Richard Fisher. Danielle, it's good to see you. So let's start with these Fed officials chiming in, because this was interesting, Danielle. This made headlines. You got Beth Hammack saying rates could be on hold for quite some time. And then you had Lori Logan echoing that, saying current policy stance appropriate, she says. I mean, what did you make of that, Danielle? That does not sound like 2 Fed officials who are, jumping here, itching to cut rates because of this labor market.
It certainly does not. And I would venture to say that they have not been following some of the headlines that we've received in the last few days, whether it be from ADP, Indeed, LinkUp, Challenger Gray and Christmas, the highest January layoffs that we'd seen since 2009, the lowest hiring that we'd seen since 2009 for a January. So it does concern me. Lori Logan was quick to point out today that politics are not entering into Federal Reserve officials' analysis of the data. But given other measures, other real-time measures of inflation, such as Truflation, TRU, which really has become more adopted by the street since its addition to the Bloomberg terminal recently. Their headline is 0.74 as of this morning, and even the core, which strips out food and energy, was at 1.15%, really reflecting disinflation in services and the declines that we continue to see in rents.
So this labor market, Danielle, listen, we got the big report tomorrow, but the data points we began leading into that. I mean, you saw that Challenger, ADP, JOLTS, it's all pointing to a cool labor market. Why is it cool, Danielle? Explain that.
Well, I think the other data that was maybe not as appreciated was the employment cost index, which is actually Federal Reserve Chair Powell's favorite gauge of wage inflation or lack thereof. And that printed cooler than expected this morning at the lowest rate since 2021. And I bring up the issue of wages to answer your question in saying demand for labor is simply not what it needs to be. So this is not a supply issue. We wouldn't be seeing wage disinflation if it wasn't the case that demand for labor was cooling in the cyclical private sector of the U.S. economy. And that is something that I think that both Hammack and Logan did not pay heed to in their remarks today, which does lead one to believe that politics has entered into the analysis.
Danielle, could it be also, I'm just wondering, because the other side of the coin here, some are concerned still, Danielle, inflation, listen, it's a lot lower than it was, but you're still not at the Fed's target, right? You're still at 2%. And some being concerned, listen, you're cutting even when Atlanta Fed GDP, the tracker, it's got a 4 handle on it, Danielle, and they're worried you cut into that, maybe you reignite inflation.
Well, it's interesting you raise that point. The gentleman, Ben Herzon, who invented the GDP tracking model, just before I came on the air with you, came out with his own revisions to fourth quarter GDP, which is he's now pegging it somewhere around 2.5%, and the first quarter at somewhere around 2.3%. So it really does depend on how a GDP model is crafted. And we also get annual benchmark revisions tomorrow to payrolls. If they're as deep as we expect for them to be, then we're going to see income backed out of GDP figures. And indeed, that is one of the reasons it takes so long in the United States to date a recession, is because it takes a very long time for the Bureau of Economic Analysis to back that income data out of prior GDP prints. So I would be very cautious in looking at the great big numbers coming out of the Atlanta Fed GDP and understand that a model is only as good as its architect.
How many cuts, Danielle, for the Fed in 2026? What would be your base case right now?
I think, well, our base case right now is four interest rate cuts. And if we don't see any at the March or April FOMC meetings, then it would be incumbent upon the individual, presumably Kevin Warsh, who's going to succeed Jay Powell, to come in with larger rate cuts than what are expected to play catch up for the Fed failing to ease in the face of such obvious weakening in the labor market.
How about Warsh? I'm curious to get your take on that, Danielle. Trump has said, listen, that's his guy to lead the Fed. Did you agree with that?
Well, I have a tremendous amount of respect for Kevin Warsh. He was at the Fed when I was at the Fed, and I happen to agree with him that the Federal Reserve needs a much smaller footprint in the U.S. Treasury market, which would advocate for quantitative tightening. Just those two letters, QT, send shudders down the spines of market participants. My only concern is that Jay Powell was just as resolute as Warsh when he first started in 2008 and 18, and he was forced to back down in the face of great market turbulence in late 2018. So it remains to be seen whether or not we can truly get a next generation of younger thinking, kind of maverick type of central bankers, if indeed the markets test that person.
I had some guests, Danielle, some investors, and they've been in the game for a long time. They would have preferred BlackRock's Rick Rieder. They told me, listen, there's a guy who really knows the markets. What did you think of that?
Well, of course, the market would have preferred Rick Rieder above anybody else, and certainly he would have a greater understanding of the financial markets. But that's not to take too much away from Kevin Warsh, who started at Morgan Stanley and himself has a very intimate understanding of the financial markets. In fact, he was instrumental in guiding Ben Bernanke in the aftermath of the great financial crisis because of the depth of knowledge that he has for the financial markets. So I certainly wouldn't take that away from Kevin Warsh.
One other data point I want to run by you, because we got retail sales today too, Danielle. You saw this. It did come in softer than estimated. I'm just curious what you made of that. And then just generally, Danielle, what do you make of the consumer here? How healthy, how resilient?
Well, again, I'll tie back to the fact that wages are not growing as quickly as they once were. So how are you going to squeeze blood out of a rock? How are you going to squeeze consumption in the merry month of December for it to have actually, to the second decimal point, printed negative for the month? That was quite a surprise, including the negative revisions to November. It's clearly also based on some delinquency data that the New York Fed published subsequent to that retail sales report that the U.S. consumer is hurting outside of that top 10%.
Danielle, thanks for your time today. Appreciate it.
Thank you for having me.
We're wrapping up today's Market Domination. Don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.